Good morning. Welcome to Market Round number 210. Stuart Williamson here at the helm, APW. So this week, what news do we have? Well, the big news seems to be that inflation has fallen to 2% in the UK. That's the headline inflation, which is very good. It's been 3 years coming down, so Rishi Sunak is very pleased with himself and he thinks that it's going to help him win the next election. I somehow doubt that. In fact, in reality, I think it's a foregone conclusion that the Conservatives will be out and the Labour Party comes in. So we need to look at what that means for the UK housing market in some depth. But it is, again, a short-term blip on the bigger picture. People tend to look at short-term stuff and think, oh, the end is nigh. When Liz Truss brought in her changes 2 years ago, the end was nigh. But it turns out just to be a short-term thing. That's the way to look at property, is really look at it as a long-term approach. You don't buy a property, it's a bit like a dog. You don't buy a dog for Christmas, you buy a dog for life. And the same thing with property. If you're not thinking about it for 10 years, don't think about it for 10 minutes, to paraphrase, I think, Warren Buffett. So that's the sort of headline news. It's down to 2%. If you take out, I think the core inflation data is actually 3.9% down to 3.5% when you take out things like food and fuel, those sort of things. And it's the fuel that will affect inflation again going forward. It's anticipated it will go back up to 3% by the end of the year before dropping away again next year as fuel prices feed through. So what does it mean? Politically, it's a boost for Russia, as I said. He was banging on that, it's lower than Germany, France and the US, which is interesting. Obviously, the Labour Party say that the cost of living crisis is rinsing people of their ability to save. And I think to a large extent that's true. It is, wage inflation is going up strongly in the south, but also you have fundamentals of other parts of inflation that are going up. And being at 2% generally is a bit of a misnomer. I mean, you've got size inflation. When I was a kid, I remember buying Snickers, and I swear they were as big as your hand. Now you buy a Snicker and it's about 3 inches long, So size inflation, and we do see this. I'm sure if you get away with putting less than a gallon of petrol in a gallon, they'd be doing that. But inflation is still out there, and the Labour Party are correct. It is having a negative effect for a lot of the working people. What does the market say about it? It was a great article in the Daily Telegraph today about, and I quote, how the British property market recovery has been stopped in its tracks. This is a great bit of over-exaggeration. Okay, interest rate cuts have been slow coming through, so things are a little bit more stable than they would have been. House prices are not going up as quick as we thought they would, but it's not a recovery that's been lost. House prices fell by £170 on average in May, which is pretty phenomenal, really, bearing in mind the economic backdrop that we've got. So economically, people are out there saying that interest rate cuts will come. They were saying it would be in November. Now perhaps they're saying it will be September. But I think there's one thing for sure. The Labour Party will win, could potentially be a landslide, which is not a good thing in itself. And what we will experience is, just like when Boris Johnson got into power, we had the Boris bounce. In this case, we'll have the Starmer surge. And the Starmer surge will basically be from when the election is finished, uncertainties out of the way, interest rates will be cut fairly rapidly, I think, by the Bank of England, under some pressure, I'm sure, from the Labour Party, and we'll have a boost in property prices. The housing market will go up again. What they'll also bring in, and I said this in the manifesto, which is relevant to us, is that they will bring in an extra 1% foreign stamp duty. So it'll go to being 6% when buying from overseas, which in the bigger picture isn't a huge amount, but it's still going to start making people think it really has to be a long-term deal, because the cost of acquisition at the moment is close to 10% of buying a property. This will put it easily on to 10%. So you're going to have to hold your property for the longer term to make the money back that you've invested in it. So that's the sort of financial implications. The Bank of England held interest rates at 5.25% this week against the backdrop of the ECB actually cutting theirs. So even though inflation is lower in the UK than it is in Europe, the ECB cut rates. And that was more of a politically driven thing, I do believe. So I do think we'll see definitely the UK rates coming down, and we'll have a Starmer surge. Rates are at a 16-year high. You hear people talking about that. But compared to what? Compared to 14% back in the 80s. So again, it's looking at the bigger picture and not being sucked into the shorter term view. The end of the world is nigh. It isn't. We have got a very strong UK economy, and there's some interesting topics. There was a great report by Barclay Holmes, did their annual results, and they say they made 557 million pre-tax profits. But in the report, they go on to talk about the build-to-rent platform that they're launching, and they're saying they're going to maximise returns in today's conditions. Now, what do they mean by that exactly? Well, just to give you a bit of context, and I'll have to use some quotes here. Knight Frank have taken this data and put it into their build-to-rent market report, and it illustrates that the build-to-rent is now the most attractive sector in the UK. Currently, there are 5.7 million privately rented households across the UK, and build-to-rent is 1.9%. Knight Frank estimate that there'll be an additional 263,000 privately rented households in the UK by 2030, and the build-to-rent sector, as it's growing at the moment, will only be 3.4% of that. And that explains why the build-to-rent investment market hit 1.3 billion in the first quarter of this year, up 21% year on year, and the highest figure recorded ever for the first quarter. And what build-to-rent basically is where a block is developed by a builder. Often these are employed by big pension companies who are trying to make a return on their investment, obviously. And what they do is they have one manager. I mean, for example, I know Centrica have just announced their profits, and that was huge. Centric are one of the biggest managers out there doing this. They basically say they manage the whole block. And so instead of having individual landlords, and one might be rubbish, and one might be great, and that sort of stuff, so you can get higgly-piggly management of the block, which will affect the overall value of the units. You have just one consistent management. And at the same time, you have consistent furnishing and tenant acquisition. So they aim at a certain quality of tenant, which is great for the block, it's great for the tenants, it's great for the owners. And you can, in some cases, individually buy these flats, these apartments, or townhouses they do as well, and you can own them and have them managed by the overall group. So build to rent in the US is a huge sector on the back of, I think, Generation X becoming Generation Rent because they can't afford to buy because they don't have the cash because the educational loans they've got left. So it's spread to the UK. It's now the biggest growing sector in the UK, and that build to rent will be massive. But the fact is, the core figure, I think, for us to take away as individuals is the fact that Knight Frank do believe there'll be 263,000 more privately rented households by 2030. That's a great opportunity for buy to let as well as build to rent. Okay, so that's the bigger picture. The shorter term picture, there's a RICS report this week that comes out and says there's a rare opportunity for buyers at the moment because there's 6 new prospective buyers for every sales instruction in May, which is the lowest since 2019. So it's a great buying opportunity because there's less buyers per unit in the UK at the moment than there has been for a long time. And that's because there's a lot more stock coming through while there isn't that much appetite to buy. So it is a good buying opportunity. And these are nuggets, I think sometimes if you do read things like Knight Frank, that you can pick out from it. And that's what I try and help with. So overall, interest rates are kept at 5.25%. Inflation is down to 2%. There's an election that's going to let off some steam. We'll have a Boris bounce or a Starmer surge after that. What else does it mean? In the shorter term, the market will pick up. In the bigger picture, there's a lot of appetite with the immigration that's still going on. 10,000 people a week moving to the UK. So it's a good buying opportunity. It shouldn't be one that you should miss, and we're seeing it amongst our clients. We've got a real appetite. People are buying a lot more now than they were, say, 6 months or 12 months ago. So that's it for Market Wrap 210. I hope you enjoyed it. Please do some comments, any sort of comments you'd like. Thank you very much. Cheerio.